Hello traders, Gary Wagner here. Just about 9:30 in Honolulu, 3:30 in New York on Monday, the 14th day of July, 2014, and this is the daily report for gold and silver. Dramatic sell-off across the board in the precious metals markets, with the equities markets running wild to the upside. First to gold, as you can see, current print 1308 and change. The low on the day 1302.30, the high 1334.60. Currently off about $31 on the day, over 2% in terms of the drawdown. Silver also breaking hard to the downside, off about 50 cents plus on the day. Current print on the screen below $21, 20.90. The low 20.76, the high 21.39. Of course, we did get stopped out. We pulled some profits today as the market slid past our stops. More on our trade in just a moment, and more on silver towards the end of the show. No doubt an ugly looking day in the precious metals markets. Absolutely pulling profits, catching many traders by surprise. Now, we did go in at 1303. We continued to raise our stops up, and we sent out a special trade alert on Friday morning to raise your stops to just below 1329, whether you had it at 28, 27, you're in at 03, you're out at 27, you made a profit. We didn't have to weather most of this downside activity, and now the market is actually gone back to where we got in. We're looking at a daily chart, and on this daily chart I have put one basic Fibonacci retracement of the entire rally, 1241 up to 1345, so we had roughly $100 move. When we look at that 38% retracement, 1305, we can see that right here. And so whether or not this market breaks through here, 1305 is going to be an area we look at very closely to see if it finds any continued support or if it breaks below there. Because just by taking a cursory look at this particular price point, 1305, and let me go ahead and draw a line straight across, we can see that this was a period of resistance right in here. Market comes down, beginning of June, we see our rally. It pops above that, but when you can consider where the lows were, they all fell above this particular price point. So it was a supportive point. Market did dip below there, but is now currently trading above there. 1305 current level of support. If it breaks through this, you've got 1293 and then 1280. Those are the varying levels that we would look for if the market continues under pressure. You know, when we look at the intraday charts, this is a 360-minute chart. Let me go ahead and blow this up. We can see some patterns developing from there. And here's what I'm looking at. When we look at the first part of this rally, starts beginning of June, 1240 takes us up to about 1280. We get exactly a 61% retracement right here. What I've done is I've put in an extension, and on that extension, this is an extension, we'll call this wave 1, call this wave 2. The extension here takes us up to about what? This is 161% extension and 176. So it actually makes it above that top before really slipping and moving hard, giving up almost all of that ground. And when we look at it through this chart, again, that 1311, we are now below that particular price point. So we could see some pressure, but as I said, we do have some good support in this area. Now, there's no doubt I was looking for higher pricing this week. However, we never really know what's going to happen in the market, and for that reason, we did trail our stops up. I'm very glad that we did, because it allowed us to capture some profits in a situation that could have been a lot uglier had we just left that stop, and I believe we had it below 1311 before we moved it up. So one of the questions we need to ask ourselves really is, have we seen any kind of really long-term damage in terms of a technical basis as this market came down? This is a 2-day Japanese average chart. And what we're looking at with this Andrews pitchfork is the fact that we have not yet traded back into this band right here. Because if it goes back in this band, it's just telling us we are in and have been in that bearish scenario. We were faked out right here. And if it goes back into the band, we had another, call it false start or false alarm. So when we look at this most recent drop in the gold market and gold prices, we've got two different fib retracements. One is the entire span of the big rally starting at the end of 2013, culminating beginning of 2014, and then one on the correction. And then if we look at this price point, we talked about this a little bit last week. This is the closest we got to any kind of harmonics, meaning these two are together. But again, 38% and 50% right around 1311, 1316. We've definitely broken through there. And so what we want to do is really see, is it going to hold in this area, or are we going to go to the next logical area? And those numbers are the numbers that we just talked about. You know, there's absolutely no doubt this market can and does turn on a dime, and it does it when many of us least expect it. I believe that because technically profit taking was so unlikely that it was really time for them to pull the plug, hammer it, so to speak, and bring the market down. That was one of the primary reasons that we did raise our stop on Friday. Looking at a daily chart, and this is Japanese average format, and even in Japanese average format, you can see color has gone, of course, to red. We've got this elongated candle here, and now it's just a matter of seeing where this market closes today. Now, of course, when we look at our weekly chart, Japanese average format, it's going to lag behind. You can see this pivotal candle here. It hasn't really gone, of course, to red yet, but when we remove the indicator, meaning the Japanese average is an indicator, that's really when we can see the dynamic move that we're witnessing here, this being an engulfing bearish in terms of a single candlestick pattern, and you would see if we get confirmation on the following week, such as you got here. But on the weekly charts, these are not charts that we trade off of as much as they are charts that we simply look at in terms of a bigger picture. Silver also showing a dynamic sell-off today. We put our stops under 21, so whether you got stopped out in this area, call it 2090, you're in at 2060 out of 2090, or picked up 30 cents profit on the trade, it's absolutely better than a loss. We can see that this has gone to a 61% retracement. The retracement is of this correction here, in which we saw the market jump from about over 22 to just above 1850 per ounce. When we do that, we have these different areas, of course, 76 and then 61 takes us to 2084. That is our new level that we will look at as support. Resistance 2036. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.